This week's Metals and Markets is brought to you by Doc Steels. The lowest price bullion dealer online has decided to drop their prices even further every week on select products. These deals can be viewed at sdbullion.com/deals. This week, the featured deals start off with a new beautiful 10-ounce silver bar from Republic at only 59 cents over spot any quantity for the stunning Soaring Eagle design. The bars feature a brand new, unique design, the Soaring Eagle, that is sure to impress any investor. Also this week is the 2016 10th ounce Gold American Eagles at only $14.99 per coin over spot for any quantity. This has been one of the most popular deals in recent memory this week. And finally, this week is 15% off any Berkey water filtration product. With all the contaminants in public water today, including fluoride being added to most municipal water supplies, water filtration is a must for you and your family's health. I have a Berkey unit sitting on my own counter in my kitchen, and I have to tell you it's some of the best water I've ever tasted. Remember, these deals will expire Monday morning at 10 a.m. Eastern. This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend Steve St. Angelo. He's better known as SRSRocco. It's great to have you back, Steve.
Yeah, hey, Doc, and hey, Eric. A lot of things are happening, and so I'm glad to be back having a nice talk with you guys.
All right. Well, we're recording this week's show late in the afternoon here on Thursday, and it's certainly been an interesting week for the metals, and this week gold in particular, as it's been pretty obvious that entity or entities really don't want to see gold break above 1360. If you look at about a 7-day chart for gold, I think about 5 out of those 7 days, gold has been hammered as soon as it taps or breaches through the 1360 level. So let's start out with the market action here. What's your guys' thoughts on current trading and the significance of that level? Are they simply trying to prevent a quick surge to 1400 if new highs are taken out?
Well, the FOMC release is really the most critical news event of this week, and it's amusing to watch how, though we're a little bit higher today in gold. Gold right now is at 1351, up about 0.2% for the day. After yesterday's smash, people in the Bloomberg circuit and CNBC are kind of pontificating, saying, well, maybe the interpretation of the FOMC minutes were too bearish at first, and now all of a sudden people are considering it more dovish. And this is just nonsense. We had a huge raid yesterday, and they beat down the metals by dumping futures contracts into the market to absorb the ongoing interest in this reboot of our bull market. These kind of machinations are going on, like Doc said, so it's more than 7 days, actually. If you look at the chart for silver, it's been a constant push trying to get over 20, gets over a little bit, gets beaten back, and then, we keep rising and pushing further. And that is the kind of action of a bull market under attack by, the powers that be. They want to control it, but they're not able to control it. Long-term, negative interest rates are a powerful driver, and more people are waking up. Just in the last week or so, we saw, I forget the exact date that it came out, but Jacob Rothschild penned his investment summary, and that was rather interesting because he's super bearish on equities now, too. So, all these large, respected investors like the Soroses of the world and Rothschild and so forth are making a lot of bearish noises, and more people are paying attention to it, and that's what's going on. It's driving our markets further and being able to resist the cartel from capping. But we're going to get over this kind of congestion, and when India comes back online, in particular, in about 2.5 weeks, we're going to get a lot more physical buying, and that's going to support the market.
Yeah, I agree with those points that you talked about. And I think people say, well, why is the gold and silver trading at this ratio? It's 10 to 1, that's what the mine supply is. Why isn't it 10 to 1? That's 10 to 1, 15 to 1, that's the historic. Well, they're basing the price of gold and silver as a commodity, not as a store of value or protection of wealth. It's based upon what they get it out of the ground. So if we figure that the gold miners are pulling gold out about 1,200 an ounce, give or take, and then the silver miners are pulling it out at 17. That's about a 71 ratio. Well, if you look at Kitco, we're somewhere there, 68, 70. So this is how the computers are set up to trade gold and silver. Until we start seeing where you get, let's say, a surge of investors coming in, like what happened in 2010 and 11 into silver. So, and we're seeing the same thing happening, you know, at the beginning of this year and up until recently. A lot more traders coming in and buying silver contracts and pushing the price up higher in percentage than gold. So this is the way the system is built up. And just like Eric said and Doc said, if we get above 1360 and we get above 20.5 for silver, well, then the next cattle call comes in, and you get the next group of trend traders come in, and that really pushes up the price higher. And that's when the commercials start to get into, you know, trouble, because now they are still at record high commercial short positions, maybe not exactly the highest in the last couple of months, but so that is why the 20.5 silver and 1350, 1360 gold is such a big demarcation line, because if you do get above that and we start seeing a lot more traders come in, it could be a lot more pressure on the commercials.
Well, I agree. I think that we're going to definitely see much higher prices as the year unfolds. I mean, this is one of the most powerful bull markets in history, frankly, and it's the most powerful bull market, second possibly to the NASDAQ market that I've ever seen personally. And it's going to be a one for the record books. I think we're probably in the second inning, frankly, of this third and final phase of the bull market move. So, this year, we'll also see a lot of geopolitical tensions in the election. It's going to be a circus. It's going to be insane, frankly, and it's going to heat up a lot more than what we saw in the primary contest. So all of these things are going to kind of coalesce around a kind of level of uncertainty that we haven't seen in multiple markets and on a geopolitical front that is going to be unbelievably bullish for both precious metals and just hedges against downside action and volatility in the stock market and so forth. But what's really interesting, and I've begun to give a lot more consideration to what could be wrong with this thesis in terms of a shorter-term outlook, I think that we might, later as the election season unfolds and as 2017 unfolds, we're probably going to see a reversion to fiscal stimulus as opposed to all of this monetary stimulus. Our guess it's in the tune of somewhere north of $20 trillion since the 2008 crash, and it hasn't worked. Policymakers are now increasingly talking about this with just complete befuddlement, and they're just besides themselves as far as recognizing that this Keynesian experiment of constant liquidity injections have completely failed. And what may be partly behind what's going on with the equity market is that people are possibly starting to price in a gigantic infrastructure spend on the order of maybe even as much as $3 trillion. I kid you not. Those are the kind of numbers that are floating around. So maybe we might see something that will be a shorter-term correction in the stock market, because that's kind of like what is happening when it comes to people's fears about economic rollover, profits declining, and rot within the European banking system, threatening counterparties and pressuring the financial system in turn. All of these things could easily create the kind of scenario where, mixed up with the uncertainty of the election and just the backdrop of geopolitics, could in fact result in something that would give us a pretty significant correction later this year. And from that point forward, maybe we'll see a fiscal justification. Policymakers responding to that kind of chaos in the market. We've seen back in August 2015 around a large correction, in large part driven by FX market perturbations with China and their quick devaluation. And those are the kind of things that make the policymakers respond quickly. And they responded to the warning that China had sent after the December 16th federal, the FOMC interest rate hike. And I think that we'll see some changes in policy in the not-too-distant future that is going to make headlines and change the way people look at the whole inflation calculus. So, later this year, the stock market is going to drive what policymakers are going to do, and that's going to probably be the most important thing to watch.
Okay, Eric and Doc, I wanted to kind of explain some new, let's say, root analysis, new information. But before I get into that, I know you like to talk about what's happening in the silver market. I'll just let you know, global silver production, according to this one company I look at, we're up 2 million ounces in January to May over last year. So we had 348 million ounces last year, and now this year, first 5 months of 2016, we're at 350. So we're up 2 million ounces. Many analysts thought I thought so too, we would see lower silver production. But looks like the reason for that increase was mostly Peru. Peru brought on some big copper mines, and so there's a lot of byproduct copper coming into the market, byproduct silver production from copper. But I do think the base metal mining industry is going to be hurt the most over the next 5 years, and this is where I see the most significant decline in silver production, and that's just supply. But I know gold and Silver Eagle sales are much different. Gold Eagle sales are still kind of holding up somewhat. They're at 30,000, but Silver Eagle sales are only 380, and we're past halfway mark. So I haven't seen a 13-to-1 silver to gold Eagle ratio for a long time. So we can see there's been some difference, some changes in the silver market, retail market. What do you see?
Yeah, I mean, we're still seeing pretty strong business, but yeah, if you look at the U.S. Mint's numbers, I mean, this week they've only sold 155,000 coins, only 150,000 coins last week. I mean, looks like they're barely going to break 500,000 for August, which is pretty crazy when you look at the numbers for the first half of the year. But again, I still think a lot of this is the primary dealers working through inventory, and I said a couple of weeks ago that if I had to guess, if the market doesn't change, we'd probably see 4 to 6 weeks of this. So we'll see if that forecast is right. I think they probably still have a few weeks to go, that the APs are recognizing that, hey, we're in the second half of the year. There's only about 3 or 4 months left in the year, and I've built up a stockpile of 3 million current year Silver Eagles. I don't want to be sitting on this many when the calendar rolls to 2017. So where my mindset had been, stock up as many coins as possible for a shortage. Now it doesn't look like a shortage is imminent, so I got to work through some of these coins. So, I mean, I guarantee that the retail market has purchased more than 150,000 coins this week. I mean, unless SD Bullion's suddenly like half of the market, which I don't think is quite the case. It might be nice, but so unless that's the case, the retail market is buying more coins than that, and the APs are just working through some of their inventories. And I think it'll be a few more weeks, again, unless there's some sudden impact in the market that triggers a massive acceleration of demand. I think you'll continue to see that over the next probably 2 to 6 weeks.
Yeah, that's what I've heard. And looking at the whole silver market, we had a lot of buying last year, starting in July, as you know, and all the way till October. And there were some products you had to wait 2 months to get. And it didn't impact the price. Didn't even impact the price. The Indians were importing record amounts of silver because of the price. And the economy was still kind of chugging along, and so we had a decent industrial silver demand. Well, this year things are kind of like they're slowly, I call it slowly disintegrating or slowly falling apart. Industrial demand has fallen. I would imagine the large entities, maybe the Indian traders that came in early, bought silver very low, and other traders as well. They probably sold some of the silver back into the market over the last 6 months, or especially the last 3 months. So Indian imports are down, industrial demand is down, But this, to me, is just a short-term thing. And I'm actually focusing less and less on these short-term things. And so I do think these smaller numbers for the U.S. Eagles is just a temporary thing. Because to me, if you're not in gold and silver, there's something really wrong with your brain. I hate to be that blunt, but if you're not in physical gold and silver, as time goes on, and I've made this statement before, we're not insects, we're not gerbils, we're not livestock. We live 60, 70, 80 years, so we have to look at things in decades. And so when you retire, you don't retire after a year or a month. You retire after 50, 60 years. So the thing is, the important thing now to focus on is why is it wise to own gold and silver in the future? And I'm not talking 50 years. I'm talking in the next 3 to 5, 10 years. Why is it important to own silver? And it doesn't make any sense to me, or it doesn't really bother me at all that there's less silver, let's say, demand right now, currently. I think that will change on a dime. But I think the interesting thing, and Eric and I, we can discuss this, is the big change in the energy understanding of how things are going to unfold going forward. And of course, this is my analysis, but I kind of look at this analysis kind of like the Earth is flat or the Earth is round. A lot of people about energy and peak oil, and let's say the energy return on invested, they don't believe in peak oil. Now you can slam them over the head, and they'll still not believe in peak oil. It's like the Earth is flat. It's flat. It's not round. But after many years of science finally waking everybody up, well, the Earth is round. Even though it's flat in certain areas, it looks flat on the horizon. It's actually a round planet. So what this is going to take is it's going to take years for science and actually the results of peak oil to finally be realized, and then people will wake up, but it'll be too late, and that's the problem. It's kind of like, it happened too quickly, you didn't realize it, and now the situation's become out of control. And I think the issue now is, and I wanted to say this, the energy return on invested is much different than peak oil. And just to give it an idea, when we were out hunting and gathering food, a typical hunter-gatherer burned 1 calorie of energy to gather 10 calories of food. That's pretty good. They had a lot of leisure time. Well, we thought, we could do a little better job. We start, tilling the earth with some simple tools, and we could produce food at a 5-to-1 energy return on the ratio. And that was okay because we could grow more food, and we could stay in one area. We didn't have to go all over looking for food and gathering food. We could do it right where we lived. Well, then we added a horse or an oxen. Well, it lowered it to like 1 to 2-to-1. But that was okay because the oxen and horse, we cut trees down and they have plenty of pasture. We didn't take that into consideration. Well, today, the growing, harvesting, processing of our food today, and then transporting it to the supermarket, and then it ends up on your dinner table, it takes 10 calories of energy just to get 1 calorie of food on your dinner plate. Well, it looks great, but it doesn't work unless you have a high energy return on invested. And we have had that up until recently. We've had that since we started going into oil or pulling oil out of the ground in the 1900s. We've had very high energy return on invested. Well, even though we're producing a lot of shale oil, Eric and Doc, we're producing a lot of it, like about 4 million barrels of it a day. Its energy return on invested is 5-to-1. In 1970, we were producing oil in the United States at 30-to-1. So we had all these profitable barrels to do all this stuff, create the interstate highway system, to do all these wonderful things. Well, now we don't have that same amount of energy. So the thing is, you can't. What's the word I'm looking for? You can't cheat peak oil and say, well, peak oil doesn't happen because we just brought on 4 million or 5 million barrels of shale oil in the last 5 years. The problem is that oil is very expensive, and we really can't afford it, which is why the shale oil companies are in debt up to their eyeballs. And so now this makes the whole living arrangement much more difficult for Americans. And if you, to continue business as usual, if you don't have the profitable energy, you add debt. And if you look at the debt everywhere, the debt is it's going exponential. So some people may say, well, this can go on for another 10, 20, 30 years. I don't think so, because an exponential debt increase doesn't go on for 10, 20, 30 years. It ends pretty quickly.
Well, peak oil has been masked when the economic crash of 2008 happened, combined with the shale output burst that came not too earlier than that. I mean, we started ramping up shale production pretty aggressively starting around 2005, 2004. So the United States went from some 6 million barrels per day production last decade to almost around 10. quite a feat. And that, the United States, in fact, has been the largest swing producer in terms of bringing new barrels to the market in the last decade or so because of our shale revolution. And that really has masked what is going on in the energy world when it comes to the impact of peak oil and declining energy return on energy investment. It's a lot more expensive to pull oil out of the ground, and alternative forms of liquid concentrates or condensates, natural gas condensates, heavy oils. All of these various non-traditional oils are in fact making up a larger and larger percentage of our global supply, and that supply is a lot more expensive. I mean, there's always going to be bursts of production given technology's application, and that's what the shale revolution was all about. And we, have the prospects of finding new provinces where there's probably a heck of a lot of petroleum yet to be discovered in the polar regions of our planet as well. I mean, but the thing is that these things mask the process of peak oil, and it confuses people. People look at the addition of petroleum that we've been able to procure from shale, and it masks the ability to understand what is in fact peak oil up and running. In 1972, I believe, we hit peak production in the United States, and then we once again came pretty close to 10 million barrels. And that's all been shale. And now, shale wells have very rapid decline rates. The whole industry is teetering right now, and we will probably see a very fast decline in our shale production. I wouldn't be surprised if it's, halved in 3 or 4 years' time. And when that happens, people are going to not question peak oil in the same way that they're doing now.
You mentioned something earlier in the interview here that there's this idea of this $3 trillion infrastructure spend.
Yeah.
Well, you could throw $3 trillion, but if you don't have the energy, it's kind of like it's the Roman Empire. We're going down the same road as the Roman Empire. You see, if two robbers, you give them a couple of shotguns, and they get a nice meal beforehand. They go into a bank, and they steal $1 million. Now, the energy return on invested of stealing that much money and getting what that money will buy you in energy, buy a brand new car, houses, their energy return on invested for stealing that money from that bank was very high. The Romans did the same thing. They went in, but instead of using bank robbers, they had legions, and they built these legions up, and they went around taking over other provinces, and they took their resources and their wealth. And this was a very high energy return on invested. And so as their empire grew, and of course they would enslave the people. See, they didn't have oil, so they had slaves. So that was the energy, was the slaves. And so even if they died, they didn't care. They'd get more slaves. So it's unfortunate, but that's the way they saw things. But when their empire got so big, they could no longer attack and get more provinces and more resources. They had to defend all this stuff now, and that cost a lot of energy, money. So they debased their currency. Well, the whole thing fell apart when they could no longer continue to expand. So they had to live off of the 5-to-1 energy return on invested of their farmers. Well, what they decided to do was they wanted the farmers to grow more food, so they taxed them higher. Farmers said, to heck with this. I'll just grow enough food just to take care of my family. Well, then they came back and said, well, we're going to tax you on what you should have been growing. So then the farmers just left the land. And this is how the whole thing kind of imploded. And so right now, our shale oil is 5-1. And the human actual labor for growing food is 5-1. The Roman economy, which was all expanding, had 1 million people in its city, had all these roads, had all these forts and all these legions to pay for, they couldn't afford to survive on that 5-1 farmer energy return on it. They needed 10, 15-1. The United States is in the same predicament now because shale oil is 5-1. Well, we have advanced education, college. We have health care. We have entertainment. We have technology. Technology costs a lot of energy. People think technology saves energy. No, it's a energy drainer. It's like Pac-Man. It just devours energy. So you don't see it in the energy matrix. So now the problem is the U.S. can't sustain itself on its shale oil. And so now we're in big trouble. And if you look at the top 3 U.S. oil companies, and people say, I still believe in peak oil because it's the oil companies, it's a grand conspiracy. They're controlling everything. Well, if they're controlling everything, how come they're losing money now? I mean, they're losing serious money if you include their dividends. It's like, I think in 2011 when oil prices were high, things were doing pretty good. I think Chevron, ExxonMobil, and ConocoPhillips, after they paid the capital and their dividends, they had 16 trillion left over, 16 billion left over. Well, and that's the first half of 2011. The first half of 2016, they're 18 billion in the hole. How can there be a grand conspiracy of the energy companies to manipulate everything if they're losing money? They got to borrow money to pay dividends. People need to start waking up. The situation will get out of hand, and it'll get out of hand quickly. And we can tell it's happening because when the world has gone doubled negative interest rates in the government bonds, sovereign bonds now, 13.5 trillion, and that number is probably even higher. I think that was a couple of weeks ago. And it doubled in 6 months because when you have so much debt, Doc and Eric, in the system, you can't afford to service the debt at 3 or 4% interest rates or 5%. You have to lower interest rates when you have all this debt. And then that's the problem. And if you don't have...
Which is why we're headed towards NERP.
Which is why I believe the United States eventually have to go to zero interest rates. And again, if you don't have the profitable energy, you can't have positive interest rates either. So the energy is the basics. And let me end it by saying this. This is the reason why I am a precious metal enthusiast or a precious metal investor, because gold and silver are stores of this very hard energy returned on invested energy. It's stored in that 1 ounce gold or silver coin. But all the 250 trillion in stocks, bonds, real estate, as well as insurance, and people thought insurance companies were safe. Well, they're in big trouble. And I hear if the insurance companies go down, the whole system goes down because you can't really hedge anything without insurance. So the insurance companies was on zero hedge a week ago. They invested in shale investments. Well, they found out what a mistake that was because shale is garbage. I call it subprime energy. So not only do you have subprime energy, you got subprime housing, you got subprime auto, and now you got subprime bonds, which aren't quite yet subprime U.S. bonds, but they'll get there. So the whole U.S. economy is subprime. So if you want to protect yourself, to me, the best place to be is in physical gold and silver, because most of the other assets, which need very high energy return on invested to survive, real estate, stocks, and bonds, are going to be in severe trouble. Now, this is not something that's going to happen next week or next month. But again, we live long lives, so you have to protect yourself over the next 3 to 5 years, a decade, and longer. And I think as time goes on, the world will realize that people will realize that the world is round, peak oil is round, and it's not a flat Earth, and so things will change, and I will see a lot more people moving into the precious metals, which is why their values will explode compared to everything else.
Because as we talk about inventories available here, and there's a decent amount of inventory right now in the summer, I mean, that's with a fraction of a percent of the population invested. If you move that number to 2% or 5%, which, Steve, you referenced 5% as a joke, I mean, that completely changes the physical supply equation.
Oh, yeah, and, there's this one question someone asked in this recent webinar. Why is it 5%? And, 5%, why do certain gold analysts recommend 5%? Like Rickard says, you should put 5% in gold. Well,
actually, he says
Rickard,
10.
Yeah, or 10%. Okay, 10's good. But you see, Rickard is a smart guy, but he's basing his information on tactics 2 decades ago. And he doesn't, I don't think he really understands his energy return on invested and how much things are changing quickly. So 10% is insurance. You need a lot more. So why would you have 10% in gold and then put 90% stocks, bonds, and real estate? It's like, it's ludicrous. So now I think people should start really looking at moving that percentage up. And in silver, it's much less. I think it's a fraction of a fraction. So you're correct. And this has been, I mentioned this in a past interview, this debt, U.S. debt since 1980 has increased 22 times, the public debt to $19.4 trillion. Well, ironically, the Dow Jones is now up 21 times, same since 1980. And the S&P, I think, is right up 21 times too. Well, isn't that ironic that the debt and the Dow Jones and the S&P average are up in the same 20 range? Because it's all debt-based. And so I think the issue is you don't want to be in these debt-based assets of stocks, bonds, and real estate. And I still get people emailing me, well, isn't real estate a physical asset? Well, it is. But you need energy. What happens, Eric, you just mentioned it, when oil production in the U.S. really declines? Well, the value of a commercial or a residential real estate, or let's say an industrial warehouse, is based upon trucks and cars and people moving. You need economic activity. Well, if oil production really declines, and it will, then you're going to have less economic activity. Well, those values of that real estate are going to plummet. And when the world wakes up, then they're going to start moving out, and they're already top commercial real estate guys are saying it's a bubble. We're at the bubble already, and I don't think we're going to have another bubble. I think this is the bubble that ends all bubbles. So again, I'm being a little passionate here because I really think a lot of people don't get the energy. They really don't get the energy, and the energy runs everything. And so when the energy is in big trouble, all those supposed claims on energy production, like stocks, bonds, and real estate, they are going to implode in price. And so the only way to protect yourself is not to be in those. And I would imagine some of them will do okay, but the majority will not.
It's interesting that a lot of people really readily understand precious metals as a store of value that is unencumbered with counterparty risk. And in a roundabout way, precious metals are a store of value unencumbered by energy risk as well, too. It's an interesting way of thinking about silver, and you champion that. And I think people need to wrap their brains around the fact that it takes a lot of energy to mine, and having metal in one's hand is something that will be perceived as having value by society, even under social duress conditions. And we've seen examples of that in Argentina and inflations of other countries, and precious metals will be able to hedge that kind of volatility coming out of our economy. So, the energy aspect of what a store of value in precious metals represents is something I think that's really underappreciated, and the work that you do spotlights that better than probably any analyst out there doing it. So I'm glad that you constantly hammer the the point.
Well, I appreciate that, and I hate to be a broken record, but you know what? After I put out this article, the coming breakdown of the U.S. and global markets, explain what most analysts missed. It's had to be my most. I get the most replies, feedback from followers, new and old, and light bulbs went off. And to tell you the truth, light bulbs went off with me as well. I saw things, and I continue to see things unfolding, and light bulbs are going off. And let me just say this too: most of the analysis going forward is going to become less and less meaningful because they don't use energy as the foundation. And you have to get to the root to the problem to understand the problem. And everyone is on the outskirts of it. They're looking at, well, labor productivity is much lower today than it was in the 50s. I saw an article. I'm thinking, you've got to be, I hate to say it, you've got to be an idiot because the amount of energy return on invested we had in the 50s was so high. That's why labor productivity was so high in the 50s and 60s. That's why it's so low now. And the thing is, I hear one comment is, well, why get in precious metals if the energy system falls apart? It's going to be like Mad Max, or that could happen. I don't know. But it's better to be in guns, bullets, bulk food, and water. I'm thinking, well, those are good things to have. But I would rather have precious metals after a collapse than have paper assets. Because at least if the things are bad, your gold and silver coins are going to provide you options that your worthless 401k will provide you zero options. So the thing is, at least having physical metals will at least give you better options than a worthless piece of paper that gives you no options. So there's no guarantee in life, but that's how I look at it at the worst case scenario for gold and silver. I think they'll give you better options than most of the other assets, because I travel a lot, and I go down and I see these 3,000, 4,000, 5,000 square foot homes. And what I see, it's kind of like the Sixth Sense. The guy goes, I see a lot of dead people. Well, I don't see dead people, but I see a lot of dead neighborhoods. I see a lot of dead activity. I see homes in the future that are just abandoned because we won't have the energy to run them. And so you don't want to be in a 4,000, 5,000 square foot home that needs a lot of natural gas and electricity, and you've got to drive to work. You don't want to be there. You want to be in a home maybe that's smaller and closer to a farmland. And I'm just making a generalization here. So when I drive around, I see the future as it unfolds, and I think people don't see it that way. Most people don't. They see that we're going to continue building and adding more strip malls, more manufacturing, or not manufacturing. We don't do much of that, but we're going to add more things. And I think we're at the epic. We're at the peak now, and I think things are going to start to unravel. And they are unraveling in different regions of the country. Where I live, things are a little bit better. But I think in the Northeast, things are much worse for people because of the infrastructure. So I just wanted to add those few things, and I think I would like to continue talking about this in the future, because this, to me, Doc and Eric, is manipulation and the debt, and we know Deutsche Bank's manipulating silver. We know they're keeping the price capped. But it's like, we're going to get past that, and you better worry about where your food's going to come from. You better worry about, you have good supplies of water. Because I listened to this last interview just a couple of days ago about this woman, about the transportation industry. It takes trucks delivering chlorine and supplies to the wastewater treatment plant so they can function. I mean, you'd be surprised how the whole thing is interconnected, and if it breaks down, things break down. And so it is amazing, and we don't have, people think, well, solar and wind, they're not going to work. If you got some on your home for power, that's great. To power certain things, great, but it's not going to work on a global, large scale. They just don't. Their energy return on investment is too low. So I think people need to be focusing not on what the politicians are going to do. It's good to keep an eye on it, but they're absolutely clueless of the things that are going to happen and are going to change here. So you have to focus on what I can do in my area to survive. And so it might not be next week or the week after. You go to Starbucks, you go see the movie, you go to, Outback Steakhouse. And I would recommend people do that for a little while, because I see in the future, I see whole areas of restaurants just closed down. So that's how I see it. Is that pessimistic? I don't know. I think it's realistic, but it's definitely different viewpoint than most people.
Yeah, unfortunately, I don't think you're going to get too much of an argument from many listeners.
I don't know about that. There's a lot of people that are extremely skeptical of peak oil for sure. And even, people constantly leave comments about, abiotic oil is real and things along those lines. So there's a lot of skepticism. This whole boom that we've had in shale has masked an enormous amount of change that's happening, and it's visible. So it's just going to take time for things to work out such that the declining energy, return on energy investment of the global energy industry has its impact on the economy, where people can see it and recognize it for what it is.
We hear more and more big companies borrowing money to pay dividends. You see, what happens when ConocoPhillips already cut their dividend. It was 74 cents a quarter. That's pretty good. Now it's 25 cents. So they cut it 2/3. All right, well, they're the first ones to get some kind of common sense. I'd imagine at some point in time, ConocoPhillips, it'll be zero. And ExxonMobil, because there's a lot of older people who are, I believe in the big caps. You get the big caps, the utilities, you get your dividends, and let's say you're wealthy and you're happy. Well, what happens when you're not getting appreciation in your stock price, which a lot of people look for? Well, I still have my dividends. I get my dividend check. Well, when they take that away from you and your stock price is falling, why the heck are you in the stock? So I think the issue is, according to these gentlemen I've been reading, they say within 10 years the U.S. oil industry and global industry will have disintegrated. I would say definitely the U.S. oil industry and a large percentage of the global. And B.W. Hill, which is the Hills Group, they're forecasting within 10 years 75% of the gas stations in the U.S. will be closed. I mean, is this fun to talk about? No, but I think it's pretty realistic forecast. They may be off by a percentage, but we're so used to seeing gas stations building and adding, we never had this idea what happens when they start closing them down. So
did they happen to mention what their forecast is for the production of the United States petroleum?
Well, they have this, and I'm actually emailed both of them. I got one response, and I'm trying to get them on an interview. And what they are talking about, and there's a lot of science there, it's based upon the actual affordable energy, the net energy. They don't care how much energy is produced. What they care about is what energy that the public gets to use to burn. Into doing things and building things and buying and goods and services. And they're looking at a collapse in the price of oil by 2020, which is different. And I asked them, I says, well, that doesn't make or work with the typical economic principle of supply and demand. And they said, well, thermodynamics doesn't adhere to human economic principles of supply and demand. Thermodynamic principles are laws of nature, not laws of man. And so when we understand that, and I don't quite understand it yet, when you see if their forecast is correct that we're going to see a falling oil price instead of rising oil price like we did in the last 2007 to 2013, 2008 to 2013, then if the oil price doesn't rise, then companies can't produce oil. They're just you're going to see cutbacks, bankruptcies, and the only that will be produced is the legacy oil. the oil that can be produced. No, I mean, it's going to take 120 or 140 to get to Arctic. And according to these gentlemen and their oil engineers and project managers, they say we're never going to see that again. We could see a hyperinflationary bout if they're going to drop money and send checks to everybody, but that's short term. I'm talking, again, 5-10 years. So I think this...
So they're basically outlining a vision that's very different from the demand destruction cycle where prices go up because of the inability to get cheap oil and supply being reduced. And then when prices go up, demand destruction comes in and makes it such that the demand for oil declines. They're not plugging into that kind of a thesis. They're basically saying that because of the decline of supply, that help me out here. I'm trying to flesh out exactly how they're thinking of the mechanics of their model.
The reason, and again, I understand it somewhat. And I've looked at his site, and he's got these like 40 charts, and he talks about actually in 2015 breaking down what we paid for oil in the U.S. economy and took the GDP, and that GDP was inflated. And he figured out that what it cost to produce the goods and services, 50% was of the energy. So we are already at that 50-50 point, which is once you cross over that, it's like death is certain. And so the issue is, yes, we could have demand destruction, and then the price would go up because of more demand would come on. But that's only happened, Eric, because we've added all this debt. Now the debt is becoming unsustainable. If you look at a chart of debt, it's gone exponential. So they don't see this, well, we could do this for another 10, 20 years. They don't see it that way. Anything that moves exponential doesn't last. It ends quickly. So actually their forecast, and I'm not saying I believe them 100%, but their forecast is $11.76 oil by 2020, because that's all it would be worth to the overall market that could afford it. Not what some rich guy would pay for gasoline, but what the overall society could pay for that net energy would be $11. And if that's true, and I'm not saying I agree with them, but if that is true, if that forecast is true, then you see supply destruction, because the shale oil companies can't produce it at 11. And they have a chart showing their price of oil, which is their ETP model, and it went up, and it was like 95% correct. The only thing they could be off on the timing, but I don't think their timing, Eric or Doc, is off by decades. It may be off by years. So, okay. And here's the deal: we had the collapse of the last U.S. investment banking system. In housing market in 2008. It's been 8 years. So they're forecasting in 4. Let's say they're off by 4. What we just went through, things could get really ugly and very quickly. It's important to look at this analysis to see if it's correct. I'm going to bring these guys on if I can for an interview to explain their work. But I think things could get very ugly very quickly, and I think it is because of the energy. And so I don't know if that extra information helped, Eric, but the debt is too high now. Mm-hmm. This is the issue. There's just too much debt now, and so to deal with the debt as well as the energy problem, it's becoming unsustainable. So that's why they don't see a bump up and then crash and then a bump up. They just see a crash.
Yeah, interesting. Well, definitely we'll look forward to hearing that interview when you get them.
Okay, guys. Well, again, lastly, this don't know if it'll work out this way. Don't know if this is the forecast will be the reality, but I do think it's just a timing issue. I think things are going to get bad, but they may take a little bit longer to get bad. But that doesn't mean, we're going to have business as usual from those 10, 15 years.
All right. Well, before we let you go, Steve, if you could let your listeners know about your subscription newsletter and where to find that.
Okay. Well, right now we have a free. If you go to my website, there you could sign up and get free reports, and I put 2 or 3 out a week. And I'm going to show. Before we go, I think the silver miners in this transition will be some of the best stocks to own. Again, not everything is garbage. I think the miners could be silver miners, especially because it takes about 120 times more fuel to produce an ounce of gold than it does an ounce of silver. I think my estimation it was about a third of a gallon of diesel to produce an ounce of silver, and it's 34 gallons of diesel to produce an ounce of gold, and that's Newmont and Barrick. So it takes almost 120 gallons more to produce an ounce of gold and silver. So I think the silver miners will be actually good stocks to own. And this is not a guarantee how things fall, but because the silver might be hard to acquire, when things start to unravel, the next best thing is going to be the miners. So I think the miners will be a good place to consider. But check out the SRSRocco report .com, and I'll continue putting out this analysis. And people, your readers and followers are more than welcome to check it out.
All right. Thanks, Steve. Always great to have you back in the show.
Okay, Doc and Eric, I appreciate the time.
All right. For the Doc, Eric Dubin, and Steve St. Angelo, thanks for tuning into this week's SD Weekly Metals and Markets. This week's Metals and Markets is brought to you by Doc Steels. The lowest priced bullion dealer online has decided to drop their prices even further every week on select products. These deals can be viewed at sdbullion.com/deals. This week, the featured deals start off with a new beautiful 10-ounce silver bar from Republic at only 59 cents over spot any quantity for the stunning Soaring Eagle design. The bars feature a brand new, unique design, the Soaring Eagle, that is sure to impress any investor. Also this week is the 2016 10th-ounce Gold American Eagles at only $14.99 per coin over spot for any quantity. This has been one of the most popular deals in recent memory this week. And finally, this week is 15% off any Berkey water filtration product. With all the contaminants in public water today, including fluoride being added to most municipal water supplies, water filtration is a must for you and your family's health. I have a Berkey unit sitting on my own counter in my kitchen, and I have to tell you it's some of the best water I've ever tasted. Remember, these deals will expire Monday morning at 10 a.m. Eastern.
We're a little bit higher today in gold. Gold right now is at $13.51, up about 0.2% for the day. After yesterday's smash, people in the Bloomberg circuit and CNBC are kind of pontificating, saying, well, maybe the interpretation of the FOMC minutes were too bearish at first, and now all of a sudden people are considering it more dovish. And this is just nonsense. We had a huge raid yesterday, and they beat down the metals by dumping futures contracts into the market to absorb the ongoing interest in this reboot of our bull market. These kind of machinations are going on, like Doc said, so it's more than 7 days. Actually, if you look at the chart for silver, it's been a constant push trying to get over 20, gets over a little bit, gets beaten back, and then we keep rising and pushing further. And that is the kind of action of a bull market under attack by the powers that be. They want to control it, but they're not able to control it. Long-term, negative interest rates are a powerful driver, and more people are waking up. Just in the last week or so, we saw, I forget the exact date that it came out, but Jacob Rothschild penned his investment summary, and that was rather interesting because he's super bearish on equities now, too. So, all these large, respected investors like the Soroses of the world and Rothschild and so forth are making a lot of bearish noises, and more people are paying attention to it, and that's what's going on. It's driving our markets further and being able to resist the cartel from capping. But we're going to get over this kind of congestion, and when India comes back online, in particular in about 2.5 weeks, we're going to get a lot more physical buying, and that's going to support the market.
Yeah, I agree with those points that you talked about, and I think people say, well, why is the gold and silver trading at this ratio? It's 10-to-1. That's what the mine supply is. Why isn't it 10-to-1? That's 10-to-1, 15-1. That's the historic. Well, they're basing the price of gold and silver as a commodity, not as a store of value.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend Steve St. Angelo. He's better known as SRSRocco. It's great to have you back, Steve.
Yeah, hey, Doc, and hey, Eric. A lot of things are happening, and so I'm glad to be back having a nice talk with you guys.
All right. Well, we're recording this week's show late in the afternoon here on Thursday, and it's certainly been an interesting week for the metals, and this week gold in particular, as it's been pretty obvious that entity or entities really don't want to see gold break above 1360. If you look at about a 7-day chart for gold, I think about 5 out of those 7 days, gold has been hammered as soon as it taps or breaches through the 1360 level. So let's start out with the market action here. What's your guys' thoughts on current trading and the significance of that level? Are they simply trying to prevent a quick surge to 1400 if new highs are taken out?
Well, the FOMC release is really the most critical news event of this week, and it's amusing to watch how,
or protection of wealth. It's based upon what they get it out of the ground. So if we figure that the gold miners are pulling gold out about 1,200 an ounce, give or take, and then the silver miners are pulling it out at 17, that's about a 71 ratio. Well, if you look at Kitco, we're somewhere there, 68, 70. So this is how the computers are set up to trade gold and silver. Until we start seeing where you get, let's say, a surge of investors coming in, like what happened in 2010 and 11 into silver. So, and we're seeing the same thing happening, at the beginning of this year and up until recently. A lot more traders coming in and buying silver contracts and pushing the price up higher in percentage than gold. So this is the way the system is built up. And just like Eric said and Doc said, if we get above 1360 and we get above 20.5 for silver, well, then the next cattle call comes in, and you get the next group of trend traders come in, and that really pushes up the price higher. And that's when the commercials start to get into trouble, because now